What's up guys, it's James Allen, the out-of-state investor, and today I want to walk you guys through my first out-of-state BRRRR deal that I ever did. Now this was an awesome deal, and I'm not only going to tell you the story of how it all went down, but I'll also share all the numbers with you as well. Now for those of you not familiar with this strategy, you'll definitely want to watch this video because the BRRRR strategy is a great way to scale your real estate portfolio without costing you money every time you buy a deal. Now with that said, it isn't an easy thing to do, especially if you're investing out of state, and even more so if you're a first-time investor. So if you've been thinking about trying to utilize this strategy, then you'll definitely want to watch today's video because I'm going to share some tips and advice that I used on this deal to make it a very successful one. But before I get started, go ahead and smash that like button. And if this is your first time on the channel, I buy rental properties and flip houses outside of my state, and I love teaching you guys how you can build massive wealth doing the same thing, along with how to up your own personal finance game. So if any of that sounds interesting, definitely subscribe and hit that notification bell. And with that said, let's get started. So first things first, I want to make sure that everyone understands exactly what the BRRRR method so that we're all on the same page. The BRRRR method is a strategy that stands for buy, rehab, rent, refinance, repeat. So the goal with this strategy is to fix up your rental property, and then when you refinance, you get all your money back on it, essentially giving you a free rental property so that you can take your initial capital and just do the same thing over and over and over again. So that's the BRRRR strategy in a nutshell. Now, when I started looking for my first BRRRR deal, I started looking on the MLS, and it was really hard to find any properties that met my criteria. Now, occasionally I'd find a property that did meet my criteria, but it would get overbid immediately by other investors. You see, the problem with the MLS is that when you're looking for these types of deals, there's a lot of people willing to pay a higher price than what you're looking to pay for the property. So to find the great deals, your best bet is really going to be off market. Now in this particular case, the house originally was listed on the MLS for $53,000, but it didn't get much interest at that price point because it was a bit overpriced for the area based on all the work needing done on the house. So they reduced it soon to $49,000, and then 2 weeks after that, they reduced it down to $47,000. At this point, the seller ended up getting the house under contract at $47,000, but the deal fell through because of financing, and at this point, the sellers currently had no offers on the property. So I had my contractor go around, check it out, get an idea how much money I'd had to put into this property, and after checking it out, I decided to put in an offer of $35,000. You see, I'd ran all the numbers and I figured out that the highest I could go to make this deal work would be $38,000. So this gave me a little bit of room to negotiate. So they countered me back shortly after at $44,000, and then I countered back at $36,000, but they refused to go any lower than $44,000. So I gave a final offer of $40,000, which was actually a little higher than I originally planned on going up to, but even with my highest offer, they still refused to go any less than $44,000. So at this point, I felt too uncomfortable doing this deal, especially considering all the work it needed at this point, so I just decided to let the property go. Now a few days went by and I noticed that the property was taken off the MLS, which I thought was a little strange, but I figured they must have gone into escrow with somebody else. But then a few days after that, out of the blue, I got a message saying that they'd be willing to go down to $42,000. So I was really excited at this point because we might actually be able to get a deal to work after all. I also found out at this point that this whole time I was actually dealing with a wholesaler, and apparently that was part of the reason why they had to take the property off the MLS in the first place. Now for those who don't know, a wholesaler is basically a middleman who gets a deal under contract from a distressed seller, somebody who is desperate to get out of their property. Normally we're talking about a house that needs some fixing up, and the seller may have just gone through a divorce, maybe lost their job, or maybe they just had to move out of state altogether. Either way, these distressed sellers need to sell their house and they need to sell it fast. So this is where a wholesaler comes in and goes into escrow on the property at a discounted price, promising a fast closing with cash. Then the wholesaler shops that deal over to a cash buyer at a higher price point and makes his profit on the difference. So at this point, I was very familiar with wholesaling, and I knew this wholesaler likely had a deadline to close the deal with the seller and was probably running out of time to find a cash buyer. This meant that I was likely his best option for getting paid, and it gave me more leverage to negotiate. So I stood solid at $40,000 for my offer price, and he ended up accepting the deal. So at this point now, we were in escrow on the property. We had 10 days until our closing date. We also had a very small due diligence period of about 3 or 5 days. So we immediately got the inspection underway, and for the most part, it came back with what we were expecting. I liked that the roof was basically brand new. The HVAC was only a few years old, and the electrical and windows only needed minor work. The bad news is there was a little more rehab needed than we originally thought, mainly because of some minor foundation issues. So we renegotiated this deal down to $38,000, and we ended up closing the deal at that price. Now, fortunately, the foundation issues were not anything too serious to be concerned with, and we even had a structural engineer confirm that for us. Otherwise, I normally run away from any house with medium to serious foundation issues. Those kind of deals can sometimes run you up tens of thousands of dollars, so it's normally not worth it, in my opinion, to touch those kind of deals. So we got started on the rehab. We had originally planned on refinishing the original hardwood floors that were already there, but we started to see as we peeled back some of the old flooring that there was some fire damage that had ruined the hardwood floors. So instead, we had to fix the subfloor, make sure everything was level, and just put down some laminate flooring instead. That ended up costing us a little bit more money than we planned for, but it's a good reminder for anyone trying to fix up a property. Make sure you add a buffer onto your rehab of at least 20%, just in case. Now, every time I do a rehab, the budget always ends up going slightly higher than I originally estimated because of things that come up that we weren't able to see before we started the rehab. So I always try to have that extra room in my budget. Now, this house was located in a C-class area, so it really didn't demand anything beyond a basic kind of finish. You always want to base your finishes on whatever the neighborhood norm is. You see, many investors will waste a bunch of money trying to deck out their house with things that they think will make it look really good. But that's not what you want to do when you're fixing up an investment property. So my advice is to stick to the neighborhood norm and then maybe take it up one more notch to stand out against your competition. So with all that said, this is what our rehab ended up looking like. For the major systems, we were already in a good position, and it was really just the plumbing that needed some work done on it. On the exterior, we replaced all the siding of the house with newer vinyl siding and put in a new gravel driveway, fixed some windows. Now for the interior, we did quite a bit of work. We had new laminate flooring throughout and some sheet vinyl in the laundry room. We were able to keep the baseboards, but we put in some new quarter round on them since we replaced the floors. We put in new doors, new light fixtures, we put in new drywall in a lot of places, and even new interior paint throughout. Now for the kitchen, we went with stock cabinets, which are your most basic level cabinets, and we went with some Formica countertops, which is basically a laminate countertop that has the look of a granite or a marble finish. We also went with all new black appliances because nobody was really using stainless steel in this area. Now in the bathroom, we just put in a fiberglass shower tub and a simple vanity, nothing fancy, but just making it look nice and clean. Now, one mistake I did make was getting a washer and dryer for the unit. You see, most of the rental units didn't come with a washer and dryer, so it was essentially a waste of money. And not only that, but now I created more capital expenditures for this property in the long term. So that was definitely a mistake on my end, but overall the project went pretty smoothly, and in the end it looked really good. So let's take a look at the final numbers of this deal, because I know that's what you guys want to see. So we purchased this property for $38,000. Closing costs came out to about $900. Our total out of pocket on the rehab was about $30,000. So our total out of pocket cost came out to about $68,900. Now after the rehab was done, we got it rented out at $850 a month, and then the property appraised at $115,000 almost 11 months later. So this deal turned out to be a super BRRRR, because on a refinance, you can get up to 75% of the house value back in your pocket. So 75% of $115,000 gave us $86,250 back, which means we got all our money back plus over $17,000. Now, to be fair, we did have to pay closing costs again for the refinance, which was about $4,000 this time, but that's still all your capital back plus $13,000. Now, as far as the cash flow goes, the total mortgage, taxes, and insurance comes out to $518 a month, and that's after the refinance. Also, the property management comes out to $68 a month, and the tenants will take care of any lawn maintenance or utility bills, so the total cash flow on the property came out to $264 a month after completing the refinance. And for any other expenses like future vacancy, maintenance, etc., I always keep a reserve fund for each property, so I don't necessarily include that into the cash flow numbers, but for anyone who wants to know, it's probably still about $125 a month even with those things included. So overall, I was very happy with how this BRRRR turned out in the end. With that said, there's a few things I want to make sure you guys can take away from this video to apply to your own investment strategy. Number one, you make your money on the buy. In other words, it's worth it to stick to your numbers. Now, could the deal have worked out if I paid more for it? Sure, it could have, but there's a lot of unexpected things that can come up, so it's better to be conservative with your numbers rather than trying to rush into a deal and overpay, which actually brings me to number two. For number two, always factor in at least an extra 20% into your rehab costs, because things that you don't expect to come up will always come up. So the total cost of your project will generally be more than you expect. So add that 20% into your numbers ahead of time so that you have that extra insulation. Number three, choose your finishes based on the neighborhood norm, not your personal preference. It's easy to get caught up in the HGTV spirit and want to deck out your new investment property, but be very aware of your area and don't over improve. At the same time, you also don't want to under improve either, because that could definitely affect your appraisal in a negative way. So my advice to you is to stick with the neighborhood norm as a general guideline, and then do just one notch above what everyone else is doing to make your property stand out from the rest. That will make it easier to rent out the property faster, or if you're selling it, you'll have better luck getting more interest from buyers. So with that said, I hope you guys enjoyed this video. Let me know in the comments below if you enjoy this type of content, and if you feel you gained any value from today's video, then definitely smash that like button and subscribe for more content like this. Lastly, follow me on Instagram at the Out of State Investor. Thanks again for watching, and I'll see you on the next one.